Thank you, David. And this is just an excellent day so far. What I'm going to cover today is more of an educational piece on navigating. It's called Navigating the Markets with Elliott, Fibonacci, and Harmonics. And when I think of the three sciences, arts, Elliott, Fibonacci, there's some science, there's some art involved, Elliott, Fibonacci, and Harmonics, I look for the convergence of all three. And that provides better targets. It provides more, I guess, confidence in determining the top-down approach and where things are going. So I'm going to introduce a three-step playbook, and let's get started. This is just a disclaimer for you to read. Thank you. I always like to start with my book because I'm proud of this book, The Trader's Pendulum, The 10 Habits of Highly Successful Traders. So I wear a few different hats. This book is my coaching book, and it really takes my work experience for the last 35 plus years trading the markets and puts it in a nice book to show you how to really establish your trading business and what habits you can develop in order to run your trading business, whether it's part-time or full-time. But today, this is what you're going to learn in this masterclass. So how to anticipate market direction by reading the market map. And you'll see what that market is. And I'm going to try to incorporate Elliott, Fibonacci, and Harmonics in that market map for you. And then I'm going to show you a 4 lenses checklist, how to trade with confidence, high probability setups using a simple strategy. Because yes, I think it is important to have an Elliott wave count as part of your top-down approach, absolutely. But this 4 lenses approach will show you how to get into the market once the market starts to turn. So the Elliott wave counts, the Elliott wave analysis will be your roadmap, and then you will use an approach to enter your trades, to trigger your trades, because that's what we are. We are traders, so we need to have a way to do that. And then how to trade these setups for maximum profits using risk management. And this is important for you to know because the market is volatile, and that's a good thing because there are lots of trading opportunities. And emotions are the Achilles heel for traders. You need a system that removes the emotions. So when you have a system, you can more easily remove those emotions and not get out of your trades too soon. Learn how to hold them longer. Not be afraid to trigger your trade. There are just so many different emotions that we as traders experience. And you need to filter out bad trades. And if you're planning to adopt automation, you need a foundation first. Also, your capital is likely limited. So if you blow up your account, you might not get a second chance. A little confession. I've been trading for more than 30 years. You may think I have an advantage over most traders, and to a certain extent, you're right. But in case you don't know me well, this is how I started. I traded currencies for 14 years for JP Morgan in New York and Toronto. Now I'm still living in Toronto. I was the lead trader for the British pound for 6 years. I traded it from 240 to 105 back up to 140 profitably, consistently profitable. And I've been trading for 20 plus years as an independent / retail trader like you at trading commodity futures and Forex. Okay, and now I'm also trading stocks and options. So if you are starting to think, oh, trading must be easy for Jody, but not for me, I also hit a wall after leaving the bank. And this is my struggle. On the one hand, I was confident, I had the bank experience, but on the other hand, I had doubts, uncertainty, just like anybody else. Could I do it on my own without my contacts? I didn't have any access to bank support and the flow of information once I left. Once you leave an institutional trading framework, you find out that you have very few friends. So back then, when I set up my trading desk to trade futures, because at that time there's no established Forex retail market, I had to pay $2,500 a month in data and chart fees. Now, you know that data and chart fees are practically free today. So that was my hurdle initially. So what process did I follow to remove any hint of doubt, uncertainty, and to overcome starting the month $2,500 down and to finally become an established and profitable retail trader? Well, this is what I'm going to teach you today, navigating the markets with Elliott, Fibonacci, and Harmonics, a 3-step playbook. And I can just tell you that I have always used Elliott and Fibonacci in my trading ever since I started working at the bank. And I added Harmonics within the last 10 years. Well, not that long, within the last 5 or 6 years, I would say. So let's get started. 3-step playbook: analysis, strategy, and trade management. So for the analysis, we look at the market map, which combines Elliott, Fibonacci, and Harmonics. And then the strategy that I'm going to show you is the 4 lenses checklist, although my strategy that I use and that I teach and that I'm going to offer you today is the Wavy Tunnel Pro strategy, which is just a terrific Elliott Wave, Fibonacci, Harmonics-based strategy that I will show you. And then 3 is trade management using optimal risk reward. So let's get started with the market map. The first step in achieving consistency is to have a thorough knowledge of the market to determine possible future scenarios and be prepared to take advantage of opportunities that arise. And that's your wave count. And in our system, we use the market map in order to provide market context and increase the likelihood of successful outcomes. So these are the books that I recommend and that I have read many, many times for Elliott and Harmonics. In our system, we use Elliott Wave, Fibonacci, and Harmonics in order to understand the big picture. And what is the big picture? Are we in an uptrend? Are we in a downtrend? Or are we moving sideways? In other words, what is the next move? What is the next big move? And you can ask that question on any different time frame. And of course, you need to do a top-down approach and start on the monthly charts, the weekly charts, the daily charts, and see what's going on. So that when you are trading, even if you're day trading, well, let's not take day. If you're swing trading and you're trading on the 4-hour, the 1-hour, you want to have your perspective. You want to have your roadmap. You want to have your market map. If you're day trading, that's a different type of skill that you're going to be developing. You are going to be following the market flow. So if you're trading on the 1-minute chart, the 5-minute chart, you're going to be following the market flow, and you have to be nimble, you have to be prepared, and be flexible. But of course, keeping in mind what the big picture is. And the big picture might be the last 5-day time horizon for you when you're day trading. So these are the market maps. And since the markets are fractal means that the markets repeat themselves over and over again, which means that this market map can apply to any different time frame. This can be the very big picture, so looking at the monthly, the weekly charts, and it can also be the 1-minute chart. It really depends on what your time frame is and how you're trading. So if we start on the left with the uptrend, I've simply drawn, this is the 8-wave market cycle from Robert Proctor's book, the 8-wave market cycle. So I've simply started with 5 waves up and then the 3-wave correction. Now the 5 waves can be a little bit more complex than what I've shown here. We can have an extended wave 3, we can have a double extension, we can have an extended wave 5. It really depends on the market structure, which is why it's important to have a strategy that you can use for market turning points to really be sure that the market has completed its trend move and is ready for the move in the opposite direction or the correction. On the right, we have the downtrend where we simply move down in 5 waves and then we correct in 3 waves. Every 3-wave move is tradable. That is going to be your easiest trade when you're trading the first 3 waves. And then you don't have to be concerned about, is this a correction? Is it part of a correction? Is it the trend? Are we going to morph into 5 waves, or are we going to stop and do a 3-wave correction and then have another complex correction? So you can always trade 3 waves, and you can use your Fibonacci tools to measure that 3rd wave, whether it's a C wave or a wave 3. On the right, we have the Wavy Tunnel Pro setup. And this just shows you how elegantly the Wavy Tunnel really maps out the market map, the 8-wave market cycle. And this is imprinted in my mind. I've integrated it into my mind. Every time I look at a chart, I look to see if it's an ideal 8-wave market cycle, which is tradable. If it's not ideal, if it's confusing, if it's corrective, I might have to go to a different time frame, or I might have to go to a different market. I might just leave it alone. And by the way, these setups are good on whatever markets you're trading. You might be trading stocks, you might be trading options, you might be trading commodities, you might be trading Forex, you might be trading CFDs on Forex trading platforms, or you might be trading futures markets. Really doesn't matter. This applies to all traded markets in any time frame. So this is a downtrend, same thing. This is your ideal Wavy Tunnel setup, and we have trades to identify the Wavy Tunnel setups. But you can see when the moving averages separate and you get that nice steep move down in prices, that's your trend. That's your trend. And then when price comes back to the averages, or the averages come back together, that's your correction. So that's how you have to think about it. So when you're trading the market map, what trades are you going to look for? Well, trade number 1 I have here is to buy the wave 2 pullback for your wave 3 move. And when you're in a wave 3, you can also buy the short retracements for the wave 3. The wave 3 is very often going to be the steepest move. As long as it's not the shortest leg, it tends to be the steepest move. The wave 2s tend to correct more. So very often you see your double bottoms for a wave 2. And then you can leave your stop loss below the starting point. And then you're getting in early, of course. So that's your first trade. Your second trade is to buy the wave 5. So you leave your stop below the wave 4. Now this can be very choppy, this wave 4. It can be any type of correction. It can be a steep correction. It can be a sideways correction. It can be a bit of a complex correction. You can have a triangle during the wave 4. But in our Wavy Tunnel Pro system, we have specific indicators which let us know pretty well 85 to 90% of the time, well, 80 to 90% of the time, that the wave 4 is over. So it's really important to try not to get chopped up, use your indicators, and use your confirmations. Trade number 3 is to, once you've determined that it is the end of the trend, sell the wave A or sell for the wave 3. But let's delve in deeper. So here is just, this is an example. This is the weekly gold chart. And I've just noted trade number 1, buy the wave 3, stop below 0.0 or stop below wave 2. And here we've labeled this a primary wave 1, primary wave 2. And this is what I explained, that sometimes the wave 2 corrections are deep, almost double bottoms. They correct most of wave 1, and then you can set your stop below the price lows. So this is every time you have an 8-wave cycle within a wave 1, wave 2, the next move is going to be up. So let's say you bought the market here and left your stop below 0.0. Well, we had another wave 1, wave 2 move, and you would get a you would have to hold your, stop, keep your stop in, or if you didn't get in here, then there's another entry right over here. And then I have some black vertical lines along the indicators, which really gave us another confirmation that the move was ready to happen. So when all the bungee lines coming to the lower reversal zone, and that matches the wave count, that can give traders confidence to take the trade. Over here, the same thing. All of the indicators come to the lower reversal zone. And then this line indicates whenever we have our longest term bungee strand moving above the 50% mark, that is our indication that perhaps the uptrend is starting. When the moving averages separate in a wave 3, always gives you an opportunity to get in again at the Elliott subwaves. So Ralph Nelson Elliott studied various market indices over a 75-year period in the 1930s, and he discovered that stock markets traded in repetitive cycles, and that these cycles or waves reflected the emotions of investors. And that's why wave 3s are very, very steep, because that's when investors and traders get really, really excited about trading that market, because there's no end in sight, so it seems. And these are the emotions of the traders reflected in the wave counts themselves. Fibonacci, very, very important Italian mathematician, he discovered the Fibonacci sequence of numbers. And this Fibonacci sequence of numbers is what we use as Elliott wave analysts to figure out what the retracement ratios are and the extension ratios are. By just taking, it's mathematical, and you're just dividing one number into the next number, or one number, skip one into the next number, and you're getting your 38.250% and 61.8% retracement ratios. And then if we work backwards, you're getting your extension ratios, which is 1.618, which is also the inverse of 0.618. So we use Fibonacci in our wave counts. We use Fibonacci. We use the Fibonacci tool, which I'm going to show you, to figure out extensions and retracements. Now, this is the 8-wave cycle that I based the market map on. And the 8-wave cycle is all based on Fibonacci numbers, the Fibonacci sequence. So for the uptrend, the 5-wave move higher, you can see part of the Fibonacci sequence right here. We start with one wave. So this whole thing is labeled as a wave 1. And that breaks down into 5 waves, 1, 2, 3, 4, 5. And that further subdivides into 21 waves and finally 89 waves. And these are the corrective waves. And when you put it all together, each cycle has 1, 2, that's 2, and then subdivided into 8, that's the 8-wave cycle that we've been talking about, and that subdivides into 34, which subdivides into 144. So it just shows you how integral Fibonacci is to Elliott wave counting. I want to bring in harmonics now, and this, on the left, we have our 8-wave cycle. Now, harmonics has a different nomenclature. It emphasizes different Fibonacci ratios, but look at the basic harmonic pattern where we start with the X, and then we move up for the A, and then we have a B, C, D. So think of this as the 8-wave market cycle, where we have an XA as waves 1, 2, 3, 4, 5 for the trend. And then the BCD on harmonics can be the ABC on Elliott wave analysis. So if you see an 8-wave cycle, and if you can find a harmonic pattern on that 8-wave cycle, that will give you a convergence point at point D. If that lines up with your wave C, the end of your wave C, after you've counted your A, B, C, if that lines up, then that can give you confidence that, gee, maybe this is, the end of the correction, and then we will start to head back up again. So you can use this as another tool in your arsenal. Now let's go through the 4 lenses checklist for pulling the trigger. This is the second step. After a good analysis, strategy is used to identify the exact entry point, stop loss level, and profit target to know when to trade and when to stay out of the market. And removing the emotions is key. As I said, we use the Wavy Tunnel Pro, but I'm going to show you a very simple 4-step strategy. By the way, the Wavy Tunnel Pro is a manual trading system. We have started to automate. So if you do have, so we have automated one of the trade setups. But if you are starting to automate your own strategies, whether it's a semi-automated trading system or an automated trading system, it's really important that you understand what's behind the system. And it's also really important for you to understand that not all systems are going to work well in every market cycle. So for example, if we are in a sideways market and the system is a trending system, it might get chopped up during the sideways market. So just be aware of that. And that's why I really love to teach traders about the market cycles and how to use Elliott in your trading in order to see what part of the market cycle we're in. 4 lenses checklist for trend reversal. We're at point T or we're at point 0, so that we're either at the start of the move or the end of the move. And what do we look for? We look for a reversal candlestick pattern. We want to see that the buyers, in this case, because it's been an uptrend, that the buyers are losing control and that the sellers are gaining control. That's really what a reversal candlestick pattern is at market tops. We also want to look for divergence in the oscillator or a major peak. Now, if it is a major peak, that's okay too. It could be the end of a wave 3, for example. And then we want to look for a trend line break, because most of the Elliott wave, the sequences, trade within channels. So when we have that trend line break, it's our first clue that the trend might be turning around. Actually, it's not our first clue. The first clue will be the reversal candlestick pattern. And then the 1, 2, 3 reversal is a nice little strategy to trigger the trade. So just a simple a simple example, just so that you get this methodology. Now you have your wave counts. And you're looking for a strategy to get into the reversal by looking at the reversal candlestick pattern. Now, most of the markets really had turnarounds, had market reversals on this day or around this day. So that didn't matter whether it was Forex or stocks, or really everything turned around at once because of the circumstances. So this chart is not uncommon, but this happens to be the Aussie USD, the daily chart. So we start here, we have a long tail, and a long tail is a very common reversal candlestick pattern because the sellers came in, they drove the market down, the buyers came in and took it back up. This is a candle of indecision called a doji. We're pretty well, price starts and ends in the middle of the candle, and look at this long candle. So initially, yeah, this is a very, very long candle. So this is one thing to look for when you have a long tail. That's an indication that the market might be turning around. So that's your reversal candlestick pattern. Next, we have divergence or a major peak. In this case, this is the awesome oscillator. And I actually studied with Bill Williams. He's the one that developed this awesome oscillator. I worked with him for 5 days. And this awesome oscillator continues to have red histogram bars moving down, and then we have green histogram bars moving back up again. So this is a major peak in the awesome oscillator. If you look across the awesome, this is the lowest peak. That's number 2. Number 3, you just simply draw your trend line down. This is a very steep trend. You draw your trend line, and we have a trend line break. This is the daily chart. You can always go down to a smaller time frame as well. You'll see the same thing, and the candle closes above the trend line. And finally, we move down to the 4-hour chart, and we see a 1, 2, 3 reversal on the smaller time frame. Now, there are a few 1, 2, 3 reversals here. We have the initial one, 0.1, 0.2, 0.3 right over here, and you want to wait for a candle close. So if you use this 1, 2, 3 reversal, then this is where you would be entering. But we have another 1, 2, 3 reversal point right here that would be best observed on a 1-hour chart right here, where you can enter on right above this candle top here, which would be the 0.2. So the 1, 2, 3 reversal just means that the 0.1, and don't confuse this with the Elliott wave counts. It's not wave 1, it's 0.1, which is the low on the visible chart. The market moves up, we label that a 0.2. The market moves back down and corrects the initial move up, we label that a 0.3. At this point, once we break above the 0.2, that is a signal that the trend is changing direction, because we have higher highs and higher lows. Until this point, we're still within the downtrend. Okay, and then we can always move to a smaller time frame to get in at a better price. Why? Because then your stop can be less. And that just means that you can take a bigger position if you have a smaller stop loss, if you're risking a certain percentage. Now, just to show you, I took all of the Aussie pairs on that just during that period, just to show you that we had the exact same move in all of these markets. So the Aussie Kiwi, the Aussie Yen, the Aussie Canada, the Euro Aussie, and the Aussie Swiss. The exact same moves. Not all were the exact same candlestick patterns. Like the Aussie Kiwi candlestick pattern was more of this was an engulfing candlestick pattern, but all the others pretty well had very long tails, which meant that the buyers or the sellers, depending on which currency came first, was losing control. So all of the markets, even if you put up like a bunch of stock markets and all the indices, they all reverse pretty well within the same few days. Commodities as well. Moving down to the 4-hour, yes, drawing your trend line on all of these 4-hour charts and taking note of your 1, 2, 3 reversal. It was just a question of which markets you were going to take, like which trades you were going to take. So, you know, everything was aligned, and that doesn't always happen. When that happens, that's really a sign that, like, that's another way to look at to see that it's clear that a certain move is going to take place if they're all moving in sync, if they're all moving together. So by taking the same trades in all these different markets, I mean, it's increasing your exposure, right? So it just is, because you're going to the same way. Now let's look at the 4 lenses checklist for, okay, so this is what we just did. 4 lenses checklist for trend reversal, just a review. Reversal candlestick pattern, divergence or major peak, trend line break, and 1, 2, 3 reversal. Now let's look at the 4 lenses checklist for trend continuation. So now I've put a blue box on the trend move here. And this is really the same thing as trend reversal, only instead of looking for a reversal candlestick pattern, we look for continuation candlestick patterns, and we can also look for chart patterns. We look for oscillator convergence, price within the channel, and 1, 2, 3 trend continuation. So here's an example to illustrate these points. Continuation candlestick patterns are usually, in an uptrend, are usually strong blue candles, okay? And another continuation pattern is when we have candles of indecision. So dojis, right over here, we have a bunch of dojis where it's not really clear whether we're going to move higher until we take out these price highs. And notice I drew my horizontal lines across the bodies of the candle, not across the tails. It's just a matter of preference. Oscillator convergence means that the awesome oscillator, or any new oscillator, trades with price. Price makes a new high, and the awesome oscillator makes a new high as well. That's called oscillator convergence. Now, divergence is when the price makes a new high and the oscillator makes a lower high. That's what divergence is. Price is within the channel. All you need to do is to draw channel lines around the price action to see that. And then 1, 2, 3 trend continuation is where I've drawn my horizontal lines across price, where you can label each move as a 1, 2, 3, point 2 being the breakout point for the continued trend higher. Point 2 is the breakout point. You can also see chart patterns along the way. Now, of course, when you have your Elliott wave counts and you see that we are in a flat correction, for example, or a steep correction, an ABC zigzag, or a little bit of a complex correction, you can do the exact same thing. You can draw your 1, 2, 3 reversal points across the top of the correction. So if you have your wave counts there and then you do this, that's great as well. Now, notice this wave count 1, 2, 3, 4, 5. Now, what if we add a harmonic pattern to waves 3, 4, 5? So this is another place where we see harmonic patterns. And in my course, I have I guess 5 different places where harmonic patterns show up in our wavy tunnel structure. So this is one of them, where we have the waves 3, 4, 5. Again, if you've targeted the wave 5 to be the same length as wave 1 or any percentage of waves 1 through 3, and that coincides with the harmonic pattern, that gives you confidence as a trader that maybe we are coming to the end of the move. So let's look at that harmonic pattern. This is the harmonic pattern. And then the market moves down after that. Okay, so that's a great thing to add. Now, the market made a brief, again, this harmonic pattern doesn't incorporate the tail, and if you're counting this as a wave 5, with the tail, we do sneak out a new high above wave 3. With the harmonic pattern, it's a failed fifth, but it's okay. So this is just, in summary, you have your harmonic pattern for the 3, 4, 5, and there are a few different harmonic patterns that would fit here. Now let's look at the S&P, the 4-hour, just to show you. Now this is without wave counts, but just to show you this, how you can apply trend continuation and point T end of trend to your S&P or to any other market. You have your trend continuation in channels. You've drawn your channel lines connecting the price highs and the price lows, and then the blue horizontal lines are really your 1, 2, 3 breakouts after your corrective move. So if we take the first move up, and then we break down, even if you decide on the bigger picture that the S&P is bullish and you want to maintain long positions, so this is a great channel to maintain a long position in. And then when we break down below this channel line, you might get out of your long positions and wait, or you might take a short-term options trade to take advantage of the move down, running your Fibonacci tool on this swing move. And then the market turns around again and starts to move higher. And then here we have a nice, this is probably a nice harmonic pattern actually. And then we have a drop down. I don't have the channel line completely through this point, but we do have a nice correction here. And then the market moves up, then the market moves up again. There really is no indication on this swing move that the market is turning around, but we're going to go on to the next slide and we're going to pick it up at the red circle. So that this is where we left off, right over here. And yeah, once again, the market continues to move up. We have a beautiful 1, 2, 3 pattern in here where the market makes a new high, we come down, we trade back up, but we don't make a new high, and our wavy tunnel strategies really capture this, and then we break down below this point. Confirmation, we break down through the channel line. So this is a really, really nice breakdown point for the S&P. And then we move up again, and this is very, very choppy. This is a complex correction, and then we move up again. So just quite simply, all I've done was I've used channel lines. Now, if you have your wave counts, that's even better because you have your wave counts, and this maps out the subwaves of your wave counts. I just follow very specific criteria in my 4 lenses strategy to evaluate if I want to trade a specific setup. And I remove subjectivity with these specific criteria. The greater the objectivity, the fewer the emotions. So now I'll put on my coaching hat, and it's really, really important to be objective, and to remove subjectivity. Now, as you get more and more experienced in your trading, you can become more intuitive. Like I am more intuitive today because I can look at the wavy tunnel setup and I don't really have to think. If I see a setup, it talks to me. The charts talk to me, and I can take a trade very easily. And sometimes I don't have to go through my entire checklist because I have mapped out this image in my brain so that I can pull the trigger when I see a setup. But that comes with experience. And sometimes you can get into, you can get in when you see that setup. And when it becomes muddy, at least for me, when I'm not seeing a specific setup, then I have to leave it alone. I have to look for something else, because if I then want to force a trade or get in, very often it doesn't work out. So that's where the emotions can come in as well. So the greater the objectivity, the fewer the emotions, which is why I think it's important for traders to have a trade plan and to document your trades and to be very, very businesslike in documenting your trades so that you can review your trades if you're a day trader at the end of every day, or a swing trader at the end of every week, or a position taker at the end of every month. So you can look back and see what you did well and see what you need improvement on to see how you can move from being too subjective to becoming more objective. These are habits that you can work on. The Wavy Tunnel Pro strategy has what I've always been looking for, namely clear, defined, understandable, and consistent rules that are not complicated to learn. Even people who have never had anything to do with the stock market can learn these strategies quickly. So Christian actually trades stocks, and we have students in our program that really trade anything Forex, stocks, futures, it doesn't really matter because the market cycles are the market cycles, and you really need to learn how to trade the market cycles. So now let's move on to trade management. Optimal risk reward for achieving consistent profits. Now, that's two different parts, trade management and risk reward. Let's see how we put that together. The third step is trade management. The goal is to apply optimal risk and money management in order to maximize profits. And this step can tip the balance between being profitable or not. So really what that means is you don't want to risk your whole account on one position because you want to be in your trading business for a long time. You want to have longevity. You don't want to, you want to run the marathon. So how do we do that? We have to monitor the risks that we take on any position. For example, by trading only setups with a minimum risk-reward ratio you set in advance, like 1.5 to 1, you can refine your analysis and improve your performance stats immensely. Then you need a smaller win-loss ratio then. Right, so we're talking about two things now. First, I mentioned that you don't want to risk everything on your trade. That's one aspect. So you want to risk a certain percentage of your portfolio on any one trade. Maybe that's 1%, maybe that's 2%, maybe that's 5%. But this second point is that if you track 10 trades and if you notice that you're making the same amount on every trade that you're taking versus the amount that you're losing, so you take 10 trades and let's say you win 5 trades and you lose 5 trades, but you're making and losing the same amount, that's your break even. You're going to break even. But if you're making more on a trade, so if you can let your profits run, then you can have 5 losing trades, but your 5 winning trades will be greater than your losing trades. You will be net profitable. So what I try to do is I try to extend my gains and limit my losses. Now, we're not perfect. I'm not perfect. Sometimes I make mistakes and I hold a position for too long. For example, I don't follow my trade plan. And then when I review it, I notice that I made a mistake, that I let my, my losses bigger than I originally intended. So we're only human, but we can do our best to correct our mistakes and develop solid trading habits. On this example that we started out with on the Aussie dollar, now we're ready to define the trade plan. And we are going to enter over here. So we're talking about triggering the trade on the 1, 2, 3 reversal. We're entering over here, which is 58.45, and we're leaving our stop at 57. So the stop is below 0.3. Okay, this is really, I should show you this is a 4-hour chart, but you can see it better on a 1-hour chart. So I'm taking the trade here, and the stop loss is 145 pips. Okay, that's a pretty big stop loss. It's 145 pips. So the stop loss will determine my position size based on the amount of money I have in the account. Now let's talk about Fibonacci and how we can use Fibonacci to figure out our profit targets. So what I did in this example was I just ran the Fibonacci tool on the last swing move. I could have run it on the entire move down. But for this example, I just wanted to run it on the last swing move. So if we have an extended move, you would technically run it on the whole swing move. Okay, but just for illustration purposes, I ran it on the last swing move. And that's the Fibonacci tool spits out retracement targets. I've highlighted the 38.2, the 50%, and the 61.8%. And that is how I have established my trade plan. So this is just one example on how you can establish a trade plan. We know our entry, we know our stop. Our P1 is at the 38.2, our P2 is at the 50%, and our P3 is at the 61.8%. You can also do it this way and leave your three profit targets at the 50%, 61.8, and 78.6, just to keep it simple. So the 50% target is right over here, the 61.8 is there, and the 78.6 is here. Now let's see what that looks like in terms of P&L. If you take three positions, which is what we've illustrated, three positions exiting at three different levels, the first is using the 38.2, 50%, and 61.8. That is a 12-day hold by the time your third profit target is hit. If you take the 50%, 61.8, and 78.6, it's a 16-day hold. If you take your three profit targets, this is your average profit for the first three targets. And to determine your risk reward, all I did was I took the average profit and divided that by the stop, the 145 pips. And that gives you your risk reward, 1.75. The risk reward is higher, it's 2.84, because we extended our profits. That's how you get your risk reward to be higher, when you extend your profit targets. So this is one way of doing it, just one way. It has nothing to do with taking different positions, adding different positions to it, adding on. I mean, you could certainly trade like that as well. This is just a strategy, a trade management strategy, to take all your positions at once and exit at three different points. Now let me show you how easy it is to spot profit levels using the Wavy Tunnel Pro. So with the Wavy Tunnel Pro, this actually gives us built-in Fibonacci profit targets. I mean, it just does. And when you combine, we have our bungees as well. The wave and then the tunnel would be different profit targets that we would use. And this is the 4-hour chart. So this red vertical line is where that 78.6% target is. Now and this is a nice 3-wave move up. Now notice here, just a little Elliott wave commentary. After we took our three profits, look what happened. The market retraced in 3 waves. A 3-wave move in Elliott is always corrective. You can always take another long trade there, right? You're out of your position now. Great trade. You can always start a new trade right here after a 3-wave correction, and you can use the 1, 2, 3 reversal just like we discussed to get in. So to summarize, in triggering the trade, we look at the candlestick patterns, we look at divergence or major peak, well, reversal candlestick patterns, trend line break, 1, 2, 3 reversal, and we can use the Wavy Tunnel Pro. We have 6 setups to trigger the trade, and we can set our targets with Fibonacci or the Wavy Tunnel Pro. And these are the 6 trades that we have for the Wavy Tunnel. We have the 4 breakout trades, which are the trend trades, and the end of trend trades, the PW, fill the gap, to trade this market map. Once you master the simple concepts of using the Wavy Tunnel Pro strategy, combined with the bungees and the semaphores, you can make more accurate, high probability trades each day, resulting in more profitable trades. I've been trading Forex Live for about 3 years. I made money and lost money. For the last 2 months, I've been studying the Wavy Tunnel Pro, looking at my trading history. I took 11 trades so far and closed 9 of them for profit. Am I lucky? No. I believe that I found a system that provides a high probability of successful trades. We have a wonderful community. Our coaches are always available and kindly answer all our questions. Are we lucky? Yes, that's Mila. And Mila is a very active part of our Discord group. We have a Discord group for members and a very active member of the trading rooms. And I should ask her what her updated results are, because this was a few months ago. But she is coming up with great trades all the time because she learned the system. And this is a manual trading system that has worked for me over the past 30 years and counting. but this is not about me. It's about you. And I believe that if you apply this playbook in your trading, you can become consistently profitable and achieve your trading goals, whatever they are. So what I'm offering you today is the Wavy Tunnel Pro Lite, and I call this a solid master's in trading education for all asset classes, instruments, and time frames. If you want to get a good sense of where the market is going, identify high probability setups, trade these setups with the right position size and risk reward ratio for maximum profits and lower risk, all in just a few months, so that you remove uncertainty in your trading, gain total clarity about what to trade, when and how much, and again, get massive confidence when you learn to identify high probability setups. More on that in a minute. And finally, achieve consistent profits in your trading. Then this is specifically for you. And we have a lot of experienced traders taking this program as well, new traders and experienced traders alike. The program has 3 sections. Section 1 is Elliott Waves Market Map. A lot of detail about Elliott Waves. Section 2, and how to trade it practically. Section 2 is the Wavy Tunnel Pro strategy, fantastic strategy, and Section 3 is advanced Fibonacci. So with the Wavy Tunnel Pro system, we already discussed this, there are 6 genuine high probability setups. And you're going to learn the exact trading system I've used to successfully trade in both institutional and retail markets over the past 3 decades. So there's more than 30+ years of trading wisdom collected here. What is the price? Well, I've invested tens of thousands of dollars in training over my career. This trading added to my experience. I could easily charge several $1,000s for this training. In fact, I had a student once that had spent $50K in training before taking the Wavy Tunnel Pro and told me that this program is even more valuable, but I'm not going to charge even a fraction of that. And this program is equally valuable. So you can enroll today for one payment of $997. And the website is wavytunnelpro.com/lite-course, LITE-course. So as soon as you click the purchase button, you get your login information and instant access to the Wavy Tunnel Pro Lite. Plus we have a guarantee, a 5-week guarantee. I'll give you a refund, but please give the system a fair try. Show me you did some work, that at least you took 5 trades, even if on demo, and that it didn't work for you, and I'll refund you. And better yet, set up a meeting, a coaching session to meet with me before you start the program so we can work towards some of your goals. And I can work with you to tell you what I think you should focus on based on your personality and based on your experience up to this point. Let me just tell you about the bonuses. So with this program, you get 2 months of the Wavy Tunnel Pro desk. And I'm going to show you a trade just shortly that was posted this week. You're also going to get 2 months of the Elliott Wave Desk membership. That's our wave counting service. And you're going to hear Juan talk about the Elliott Wave Desk at 4 o'clock today. So you're going to get 2 months of the Wavy Tunnel Pro Desk, which is the trading rooms, and 2 months of the Elliott Wave Desk, which is our wave counts on 20 different markets. You will also get our trade scanner for Forex, stocks, commodities, and crypto. Like I said, 4 London and New York trading rooms and analysis rooms, Trade with Confidence videos, a psychology podcast, and our automated trading system. So this was a trade that Neil, who is our trading room mentor, on August 3rd in the London room, he said, this is where we were in this market, it's the pound Canada. He said, the pound Canada is going lower, but expect a retrace. And this is, he posts this in our Discord channel. H1 expecting lower yellow semaphore after retrace up is over. And if you join our program, if you choose to, you will learn all about how we use this, how Neil uses the semaphores and the bungees to really, he calls it to, that it's part of his crystal ball to identify where the market is going. And if you hear him speak, you'll see what I mean. So he said very confidently, expect a retrace and sell. Then in the New York room, he comes in here and he says, now looking for a noble semaphore down below the tunnel, so sell again on a retrace. And we had this sideways move, and he expected a move down below the tunnel. Then the next day he followed up on this, and we're over here in the London time frame on 8/4, and he says, still after making 150 pips and counting, and he says, still looking for lower levels, very confidently, just based on the setup. And he's very humble, at least a lower yellow semaphore on the 4-hour chart. Okay, and then this is the hourly chart, so this is the 4-hour chart, so still looking lower for that. And these are the things that the students are learning from being in the trading room. Very, very powerful stuff. So he has actually come up with further trades to identify high probability trades, setups to identify high probability trades. Okay, I'd like to share my experience with you on the Wavy Tunnel Pro program. When I first started trading Forex, I learned many systems using different types of indicators, but did not have much success. I pursued EW and loved how price action actually had meaning, but no one told me how hard EW was to learn and then practice with. I found the Wavy Tunnel, which incorporates EW and harmonics, and that helped me take the next steps into becoming a better trader. I now have progressed and passed the test with one prop firm and well on the way of passing another prop firm's test. Okay, I see that my time is up. So this is your recap. This is what you get. And as an extra bonus, you will get 11 recorded sessions viewing student trades. So that's where I actually watch the student present their trades, and then we evaluate the trades. Very, very valuable as an extra bonus.